Welcome back. We're about to delve into some essential tools that will give you a clear picture of the solvency and leverage profile of any real estate company or investment opportunity. Solvency and leverage metrics. Let's start by thinking about how real estate investments are often financed. Have you ever wondered how investors manage to buy large properties? Or what makes a real estate investment a safe bet or a risky one? A big part of the answer lies in understanding leverage and solvency. So, what exactly are these terms? Leverage is a term you might have heard before. In simple terms, leverage refers to using borrowed money, that is, debt, to finance investments or business operations. Imagine you want to buy an investment property, say a small apartment downtown that you plan to rent out. If you use a loan from a bank to cover a large part of the purchase price, you are using leverage. This can be a powerful tool because it allows you to buy a bigger asset than you could with your own cash alone. Solvency, on the other hand, is about staying afloat financially. It's the ability of a company, or in our case, a real estate investment, to meet its financial obligations, especially those that are long term. Think of it like this. If an investment is solvent, it means it can pay its bills and debts over time without running into trouble. Why are these concepts so important for real estate investors? Well, solvency and leverage metrics are critical tools. They help in assessing the financial health of real estate assets and the companies that own them. Whether you are an investor looking for your next opportunity, a lender deciding whether to provide a loan, or a manager overseeing properties, these metrics are your best friends. They help everyone involved evaluate the level of risk, the capacity to repay debts, and the overall financial stability of real estate investments. In this course, we're going to dive deep into the key metrics used in the real estate industry. We'll cover the loan to value ratio, often called LTV, the debt to asset ratio, the debt to equity ratio, debt service coverage ratios, or DSCR, debt yield, and finally, interest coverage ratios. By understanding these, you'll be much better equipped to make smart decisions in the world of real estate. Now that we understand the basics of leverage and solvency, let's move on to our first key metric. Loan to value ratio, LTV. Have you ever wondered how much of a property's price a bank is willing to lend you, or how they decide if a loan is too risky? That's where the loan to value ratio, or LTV, comes into play. What is the loan to value ratio? The LTV ratio describes the percentage of an asset's financing that comes from a loan compared to the asset's estimated value. Putting it simply, the LTV shows us what percentage of the property's value is financed through a loan. Why is this percentage important? Well, a higher LTV ratio generally means a higher risk for the lender. If the LTV is high, it means the borrower has less of their own money invested in the property, less equity, and the lender has provided a larger portion of the funds. If property values drop, or if the borrower can't make payments, a high LTV means the lender has more money at risk of not being repaid. Because of this higher risk, a higher LTV will usually result in less favorable loan terms, like higher interest rates or stricter conditions. It's interesting to note that the rules about maximum LTV can be different depending on the country and the lender. For example, in the state of Israel, there are specific laws about mortgages and how much can be financed. For a first home, it might be up to 75% financing. How do we actually calculate this? The formula is quite straightforward. LTV equals the loan amount divided by the asset value, and then you multiply that by 100 to express it as a percentage. So why do we care so much about this LTV ratio? It's important for a few key reasons. Risk assessment. LTV is mainly used by lenders to figure out the level of risk in a loan. As mentioned, the higher the LTV, the higher the risk to the lender. If a borrower defaults on a loan with a high LTV, the lender might not be able to recover the full loan amount by selling the property, especially if property values have fallen. Determining loan terms. The LTV directly affects the terms of the loan. This includes things like the interest rate you'll pay, the maximum amount of money you can borrow, and whether you'll need to pay for extra insurance if the LTV is very high. Evaluating equity. LTV also shows how much equity or ownership stake the borrower has in the asset. A lower LTV means the borrower has more of their own money invested, which is a good sign for lenders as it indicates the borrower has more to lose and is therefore more likely to keep up with payments. Let's make this more concrete with an example. Imagine an apartment that is worth $2 million. Now, let's say you get a bank loan for $1,600,000 to buy this apartment. To calculate the LTV, we use our formula. LTV equals $1,600,000, the loan amount, divided by $2 million, the property value, multiplied by 100. This calculation gives us an LTV of 80%. What does an 80% LTV mean? It means that the bank is financing 80% of the property's value. The remaining 20% is what the borrower finances through their own equity. Consider how this LTV might affect your loan. If the bank's typical limit is, say, 75% for this type of property, an 80% LTV might mean you pay a higher interest rate or need to meet other conditions. If you were a lender, how would an 80% LTV make you feel about the loan safety? Now that we have a good grasp of LTV, let's move on to another important metric that gives us a broader view of an entity's financial structure. Debt to assets ratio. We've just talked about LTV, which is super useful for specific loans on specific assets. But what if we want to understand the overall financial picture of a company that owns multiple properties or has various types of debt? How do we measure how much a company relies on borrowing to fund its assets? For this, we use the debt to assets ratio. The debt to assets ratio is a financial metric that tells us the percentage of a company's assets that are financed through debt. It measures a company's total debt relative to its total assets. In simpler terms, this ratio shows what portion of a company's assets is paid for by loans and other forms of debt. It's important to understand how this differs from LTV. While the LTV ratio is a more specific tool we use for secured loans, like a mortgage on a particular building, the debt to assets ratio is a more holistic tool. It helps us analyze a company's overall financial leverage, its reliance on borrowed money across all its operations. The formula for this ratio is debt to assets ratio equals total debt divided by total assets. For example, if a company has $600,000 in total debt and its total assets are worth $1 million, its debt to assets ratio would be 0.6 or 60%. This means that 60% of the company's assets are financed by debt. Why is this ratio so important for investors? Leverage evaluation. A higher debt to assets ratio indicates higher leverage. This means the company is using more borrowed money to finance its assets. Risk assessment. Generally, high leverage means higher financial risk. If a large portion of assets is funded by debt, the company has significant debt obligations, like interest payments and principal repayments, that it must meet regardless of its own performance. Investment decision making. Investors use this ratio to assess the risk level of an investment. A company with a very high debt to assets ratio might be seen as a riskier bet compared to one with a lower ratio, all else being equal. Industry comparison. This ratio is also useful for comparing companies within the same industry. What's considered a high or low ratio can vary significantly between industries. So, comparing a company to its peers gives a better context. For example, capital intensive industries like real estate development might naturally have higher debt to assets ratios than, say, a software company. Let's quickly summarize the key differences between the debt to assets ratio and the LTV ratio, as it's important not to confuse them. Regarding what they measure, for the debt to assets ratio, it's the ratio between the total debt of a company and its total assets. For the loan to value ratio, it's the ratio between a specific loan amount and the value of the asset securing that loan. Regarding what they refer to, the debt to assets ratio refers to the overall leverage of the company. The loan to value ratio refers to the risk in a specific loan. Regarding their primary use, the debt to assets ratio is used to evaluate the overall financial condition of the company. The loan to value ratio is primarily used in the context of asset backed loans, like mortgages. So while both are telling us about debt, they are looking at it from different angles and for different purposes. Understanding both gives you a more complete toolkit for financial analysis. Next, we'll explore another way to look at a company's leverage, the debt to equity ratio. Debt to equity ratio, leverage ratio. We've looked at debt in relation to asset value, LTV, and total assets, debt to assets ratio. But what about comparing a company's debt to the owner's stake in the company? This is where the debt to equity ratio, often simply called the leverage ratio, comes in. What does it mean when we say a company is highly leveraged? It often refers to this very ratio. The leverage ratio or debt to equity ratio is a financial metric that expresses the ratio between a company's debt and its equity. Equity represents the shareholders' stake in the company, essentially what would be left for shareholders if all assets were sold and all debts were paid off. So what does a high or low debt to equity ratio tell us? A high leverage ratio indicates that the company is using a lot of debt to finance its operations and growth. For every dollar of equity, the company has a relatively large amount of debt. A low ratio, on the other hand, indicates that the company is using more of its own equity, the owner's funds, to finance its operations rather than relying heavily on borrowing. This ratio is a key indicator for several reasons. Risk. Companies with high leverage ratios are generally considered riskier. Why? Because they have to make regular interest payments on their debt and they have to repay the principal. During tough economic times, or if the company's performance falters, meeting these debt obligations can become a struggle. If they can't, they could face serious financial trouble, even bankruptcy. Profit potential. While high leverage increases risk, it can also increase a company's profit potential. Using borrowed money allows a company to invest more in its operations, like acquiring more properties or developing new projects, than it could with its equity alone. If these investments are successful and generate returns higher than the cost of borrowing, the interest on the debt, then the shareholders' returns can be significantly amplified. This is the leveraging effect. Comparison. Like the debt to assets ratio, the debt to equity ratio is often used to compare companies within the same industry. What's considered a normal or acceptable level of leverage can differ greatly from one industry to another. Consider this. If an investor is looking for potentially higher returns but is willing to accept more risk, would they be more attracted to a company with a high debt to equity ratio or a low one? The calculation is as follows. Leverage ratio equals total liabilities divided by equity. Note that total liabilities is often used interchangeably with total debt in this context, representing all of the company's obligations. For example, If a company has total liabilities of $10 million and its equity is $5 million, its leverage ratio is 2. 10 million divided by 5 million equals 2. This means the company has $2 of debt for every $1 of equity. Debt to assets ratio versus debt to equity ratio. It's useful to quickly distinguish between the debt to assets ratio and the debt to equity ratio. The debt to equity ratio measures the ratio of a company's debt to its shareholders' equity. It focuses on how much of the financing comes from creditors versus owners. The debt to assets ratio measures the ratio of a company's debt to its total assets. It shows what proportion of the company's assets are financed by debt. Both ratios measure leverage, but from slightly different perspectives. Together, they provide a more complete picture of a company's financial structure and risk. Now that we've explored how leverage is structured, let's look at how well an income-producing property can actually handle its debt payments. Debt Service Coverage Ratio, DSCR. Imagine you own an apartment building that generates rental income. How do you know if that income is enough to cover your mortgage payments? This is a critical question for any real estate investor, and the Debt Service Coverage Ratio, or DSCR, helps answer it. The DSCR examines the ability of an income-generating real estate asset to cover its debt obligations. These obligations include both principal and interest payments. The DSCR does this by comparing the asset's net operating income, NOI, to its debt payments. What is net operating income, or NOI? We'll touch on this more, but essentially it's the property's income after deducting operating expenses, but before deducting debt payments or taxes. The DSCR is usually calculated for a specific period, such as a quarter or, more commonly, a year. The value of the DSCR tells us a lot. When DSCR is greater than 1, this is good news. It means the asset generates enough income to cover all its debt payments for the period with some cash left over. For example, a DSCR of 1.2 means the property generates 20% more income than needed to cover its debt. When DSCR is less than 1, this is a warning sign. It means the asset is not generating enough income to cover its debt payments. The owner would have to find money from other sources to make up the shortfall. When DSCR equals 1, this means the asset generates just enough income to cover the debt payments, with nothing left over from operations to cover those payments. This is a break-even point, which can be risky because any unexpected drop in income or rise in expenses could push the DSCR below 1. Lenders typically look for a DSCR comfortably above 1, often 1.2, 1.25, or even higher, depending on the property type and perceived risk. Why do you think lenders want this cushion? The formula to calculate DSCR is DSCR equals net operating income divided by the debt service for the period. Debt service for the period refers to the total principal and interest payments due during that specific time frame, e.g., for the year. The DSCR is a vital metric for several reasons. Investment decision-making. It helps investors evaluate a real estate asset's ability to actually pay for its debt. A strong DSCR suggests a healthier, more sustainable investment from a cash flow perspective. Risk assessment. Lenders rely heavily on DSCR to assess the risk of providing a loan to a real estate buyer. A low DSCR flags a higher risk that the borrower might default on the loan. Loan term determination. The DSCR often influences loan terms. A property with a high DSCR might qualify for more favorable terms, such as a lower interest rate or a longer repayment period, because it's seen as less risky. Several factors can influence a property's DSCR. Understanding these can help in managing or evaluating an investment. Net operating income. This is a direct driver. The higher the NOI, meaning more income after operating expenses, the higher the DSCR will be, assuming debt payments stay the same. Annual debt payments. Conversely, the lower the annual debt payments, the higher the DSCR will be if NOI remains constant. Interest rate. A lower interest rate on the loan means lower debt payments, which in turn leads to a higher DSCR. This is why refinancing at a lower rate can improve a property's DSCR. Repayment period. A longer repayment period for the loan will generally mean lower annual debt payments. These lower annual payments will result in a higher DSCR. Let's look at an example to see this in action. Suppose an apartment building has an annual net operating income of $120,000. The total annual debt payments for this building, principal and interest, are $100,000. Using our formula, DSCR equals $120,000, NOI divided by $100,000, debt payments. This gives us a DSCR of 1.2. What does this DSCR of 1.2 mean? It means the building's annual NOI can cover its annual debt payments 1.2 times. Since the DSCR is greater than 1, it indicates that the asset generates enough income to cover its debt with a 20% cushion. This would likely be viewed favorably by a lender. Debt yield. We've seen how DSCR helps us understand if a property can meet its ongoing debt payments, but lenders also want a quick way to see how the property's income stacks up against the total amount of money they've lent. For this, they often turn to a metric called debt yield. Debt yield is a metric that measures the annual return generated by a real estate asset relative to the total loan amount. It's considered an important financial metric for evaluating risk in real estate investments, particularly from a lender's perspective. Think of it this way. If a lender gave you a loan, the debt yield tells them what percentage of their loan amount they would get back in 1 year from the property's net operating income. The calculation for debt yield is debt yield equals annual NOI divided by the loan amount, and then you multiply that by 100 to express it as a percentage. The result is a percentage that shows how much of the loan amount is covered or yielded by the annual net operating income. For instance, a debt yield of 10% means that the property's annual NOI is equal to 10% of the total loan balance. Lenders often have minimum debt yield thresholds. A higher debt yield is generally better from a lender's point of view, as it suggests a greater ability for the property's income to support the loan, independent of variables like the interest rate, amortization period, or the current market value of the property, which can fluctuate. Why has debt yield become an increasingly popular metric, especially among lenders? Risk assessment for lenders. Debt yield is primarily used by lenders to assess the level of risk in a loan, and critically, it does so regardless of the asset value or other loan terms like interest rate and amortization period. This is a key difference from LTV, which depends on asset value, and DSCR, which depends on specific debt service payments. Lenders like it because it's a straightforward measure of how much cash flow the property generates compared to the loan amount. Determining loan terms. Like other risk metrics, debt yield can affect loan terms. A property showing a healthy debt yield might secure a larger loan amount or better terms. Conversely, a low debt yield might limit the loan amount a lender is willing to offer. Comparing assets. Debt yield allows lenders to compare different assets and evaluate their risk levels in a consistent manner, even if those assets have different financing structures or are in different markets. Consider why a lender might prefer debt yield over LTV in a market where property values are very volatile or uncertain. LTV can look good if values are high, but if values drop, the LTV changes. Debt yield, however, focuses on the income relative to the loan, which can be a more stable indicator for the lender. Let's use an example. Imagine a real estate asset, perhaps a small commercial building. Its annual NOI is $500,000. A bank is considering offering a loan of $5 million to finance this asset. Debt yield equals $500,000 divided by $5 million multiplied by 100. It gives us a debt yield of 10%. The annual NOI of the asset covers 10% of the total loan amount. Lenders would compare this 10% to their minimum required debt yield for this type of property and loan. Let's see the difference between DSCR and debt yield. Debt yield focuses on the return the asset generates relative to the total loan amount. It essentially shows how much profit, NOI, the asset makes compared to the entire loan balance. DSCR focuses on the asset's ability to cover the ongoing debt service. DSCR shows if there is enough cash coming in each year to make the loan payments, focusing on current cash flow and the periodic loan repayment. Next, we'll look at a ratio that specifically focuses on the ability to cover just the interest part of debt payments. Interest coverage ratio. We've talked about covering total debt payments with DSCR, but sometimes analysts and lenders want to zoom in on just one part of those payments, the interest. How comfortably can a company cover its interest expenses from its earnings? For this, we use the interest coverage ratio. The interest coverage ratio is a financial metric that shows a company's ability to meet its interest payments on outstanding debt using its operating income. What do the numbers mean? A ratio of 1 or more generally indicates that the company can cover its interest expenses from its operating income. A ratio less than 1 would mean the company is not generating enough operating income to pay its interest expenses, which is a serious red flag. Generally, a higher ratio is considered better and safer. For example, an interest coverage ratio of 5 means the company earns 5 times what it needs for its interest payments, providing a good cushion. Lenders and investors look at this ratio to gauge the margin of safety a company has for paying its interest. If earnings decline, a company with a high interest coverage ratio has more room before it struggles with interest payments. The formula is interest coverage ratio equals operating income divided by the interest expense for the period. Example of interest coverage ratio. Let's take an example. A company has an operating income, EBIT, for the year of $1 million. Its interest expenses for the same year are $200,000. Using the formula, interest coverage ratio equals $1 million. EBIT divided by $200,000 interest expenses. This gives us an interest coverage ratio of 5. What does a ratio of 5 mean here? It means the company earns 5 times more from its operations than it needs to pay its interest expenses for the year. This indicates the company has a good ability to meet its interest payments and would likely be seen as having a healthy level of interest coverage. Interest coverage ratio versus DSCR. The interest coverage ratio looks at the whole company's profit to pay just the interest on its debts. The DSCR, on the other hand, looks at a specific property's profit to pay all of its debt payments, which includes both interest and principal payments. So, which one is more important? Both metrics are important to lenders. Both help evaluate a company's ability to meet its debt obligations and are used by lenders to assess credit risk. By understanding all these metrics, LTV, debt to assets, debt to equity, DSCR, debt yield, and interest coverage ratio, you're building a powerful financial toolkit to analyze real estate investments from various angles of solvency and leverage.